Hey, it's Robert Naini, your spray foam advisor. And this week, I want to talk about the tax implication of business entities. If you haven't seen the last couple of videos that I put out on Mondays, go back and check those out. I talked about the 5 different types of business entities that are most common out there. And then last week, I talked about the liability implications behind each of those different types of business entities. This week, I want to focus on the tax implications of each of these types of business entities. So, first and foremost, once again, general partnership and sole proprietorship are going to be treated very similar to each other. And from a tax standpoint, these organizations, these entities, the taxes actually roll up. They're called pass-through entities, and the taxes will roll up through the company and go directly to the owner's personal taxes. And so if you are involved in a sole proprietorship, or if you're involved in a general partnership, sole prop is going to go directly on your Schedule C of your taxes, and for most business types, if you're in real estate, it's going to go on to Schedule E is where rental real estate would go. But for most businesses, for your spray foam business, if it's in a sole proprietorship, it's typically going to go on a Schedule C for your standard 1040, and that Schedule C is addition to that 1040. And that's going to apply to your sole proprietorships. And then your partnerships, your general partnerships, your limited liability partnerships, you're typically going to get a K1 regarding that partnership. And it's going to lay out all of the income and expenses and the details for that partnership. And that's going to get applied directly to your personal taxes as well. So with the sole proprietorship and the general partnership, as I mentioned, those are pass-through entities that goes directly to your personal taxes. So you're going to be taxed at your personal tax rate. You're going to pay self-employment taxes on all of the money that you make in the business. It's essentially going to be your, any draws or salary that you take and distributions from the business. Dividend distributions are all going to be treated as personal salary, and they're going to go directly to your taxes, to your personal taxes. Now, this differs for S corporations and C corporations. Now, S corporations and C corporations have a little bit of a different tax implication. For example, as an employee, as an owner-operator, an owner that owns the business and an operator that is involved as an employee on a daily basis, you actually have 2 components from this business where you're going to derive income. You should be deriving income from a salary from the business as an employee for the day-to-day, week-to-week functions that you provide inside the business. The company should be paying you a salary that's deductible to the company, but that goes on your taxes for personal tax implications. You're going to be responsible for self-employment tax on that money, and then that salary is going to go just like a W-2 job would. A W-2 from any type of employment, that's going to go on your taxes, on your tax form, the 1040. And then your dividends are separate. Your dividends are going to be taxed separately, and in the case of, for example, an S-corp, the S corporation is not going to have there's not going to be a company tax, so the company is not taxed in the form of an S corporation, but then the salary that you collect and the dividend that's paid out to you will be taxed. And if you've ever heard of the risk of double taxation, this comes into play with C corporations. So in the case of a C corporation, you're going to have a salary paid by the C corporation to you. That's going to have self-employment tax and Social Security, FICA, etc. And then, sorry, not self-employment tax, but that's going to have your standard employment taxes, so the Social Security and FICA. And then you're going to also be responsible on your personal taxes for any dividends from that company. But where double taxation comes into play is that the company, the corporation, also has to file a tax return based on the corporation profits. So the corporation is going to pay taxes on money that's being made, on profits, and then those profits, after they're taxed at the corporate level, are then going to be distributed as dividends to the owners of the business, and they're going to be taxed on the personal taxes as dividends. So that's where double taxation typically comes into play. from my understanding. Now, I have never experienced that personally. I don't have any experience with a C corporation and being involved in the ownership, directly involved in the ownership of a C corporation. The closest I can get to that would be owning stocks of C corporations, owning stocks of companies that are in the form of C corporations. And where I've got dividends from that, then that would be taxed on my personal taxes as a dividend. So that's kind of an overview. Now, one entity you may have noticed that I missed, that I didn't talk about on this video, that I've talked about on the previous videos, is the LLC, or the limited liability company. And the reason I didn't talk about it, I didn't bring it up really at all until now, is that it's actually a disregarded entity when it comes to tax purposes. So from a tax standpoint, the IRS does not recognize the LLC as a taxable entity, which means the standard election, if you are an LLC, the standard election from the IRS is that it's going to be a pass-through entity, and it's going to be treated like you're going to be taxed like you're a sole proprietorship. And so the income that you make through the LLC, that's going to come, it's going to flow through on tax returns, and it's going to be applied directly to your 1040, and you're going to be taxed just as if you were a sole proprietorship from a tax standpoint. So it's going to be completely passed through. All the income is going to pass through the company. The LLC doesn't pay a tax because they don't file a federal tax return, because it's not a taxable entity in the eyes of the IRS. And then all of that income flows through to your tax return as if you were a sole proprietorship in the case of a single member LLC. If there are multiple members in the LLC, multiple owners, then it flows through to your tax return like it's a general partnership. Now, what you can do with an LLC is you can actually take a tax election. You can actually elect for the LLC to be taxed as either an S-corp or a C-corp. And if you do that, then all the things that apply to an S-corp would apply to that LLC. And if you elect to be taxed as a C-corp, then all the things that apply to a C-corp would apply to your LLC. Now, that's where it really gets deep into the weeds. And as I mentioned before, I don't have any experience with a C-corp. If you're a C-corp or want to be a C-corp, I highly recommend you go get some professional help. Talk to your accountants, talk to your CPAs, and it's good to have advisors at all levels, legal and accounting, and make sure they're talking to each other so the left hand knows what the right hand's doing. And that can be said for any type of entity, any type of organization that you're running. You want to make sure that your advisors that are helping you at the highest levels are communicating with each other, and they know what each other is doing so that they can help you out in every possible way, both from a legal standpoint and from a legal liability standpoint and from a tax standpoint. This has been Robert Naini with Spray Foam Advisor. Thanks for checking us out. Catch us on some more videos.